Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. This video presents a direct informational narration of the source document, which is the Global Market and Sector Analysis for July 20, 2026. Let's get right into it. Here is our agenda for today. We're covering 1. Macro and geopolitical risks. 2. Global leverage and factor crash. 3. Semiconductor sector dynamics. 4. Broad market technical thresholds. 5. Tech earnings and market share. And finally 6. Speculative assets and downgrades. Section 1. Macro and geopolitical risks, specifically focusing on the impact of Middle East tensions on broad markets. Recently, all three major indices closed slightly lower, largely pressed down by rising yields and climbing oil prices. The situation in the Middle East is escalating rapidly. That mid-June peace agreement between the US and Iran, it's entirely broken down. U.S. bombings of Iran have now entered their 9th day, and unfortunately, they've expanded to civilian infrastructure. In response, Iran has conducted retaliatory missile strikes on Jordan. On top of that, Houthi rebels just announced a maritime ban on Saudi Arabia. As you can imagine, this is making oil futures insanely volatile right now. But interestingly, the broader markets still expect the U.S. and Iran to eventually get back to negotiations. So these higher oil prices are really only going to stick around if that expectation completely vanishes. Moving on to Section 2, Global Leverage and Factor Crash, taking a look at South Korean market margin calls and quant sell-offs. This geopolitical anxiety is triggering a massive international contagion effect. Just look at the fallout in the South Korean market after they came back from a 3-day weekend. The sheer scale of the leverage wipeout is honestly staggering. Since mid-July, over 1.2 million leveraged trading accounts in South Korea have been hit with margin calls. Out of those, we're talking about an estimated 320,000 to 360,000 accounts facing forced liquidations as traders frantically unwind their AI-related positions. To really put that massive sell-off into perspective for your own portfolio, just look at the 2x leveraged SK Hynix ETF. It has plummeted a breathtaking 70% from its record high back in June. And the broader Kospi index, it's down over 30% from its June peak, dragging it firmly into bear market territory. Analysis from Goldman Sachs points out that this momentum strategy is almost perfectly replicating a textbook historical pullback. And they note the overall scale might actually be far more severe than the historical average, because the previous run-up was just so aggressive, the retracement hits that much harder. While the most speculative leverage has pretty much been cleared out, the programmatic selling pressure from these broken trends could easily take another 2 to 3 weeks to fully exhaust itself. All right, Section 3. Semiconductor sector dynamics, covering rebound expectations and AI infrastructure contracts. Despite the broader sector looking weak and the medium-term upward trend being fundamentally damaged, there are a few standout segments. For instance, AI data center stocks that pivoted away from Bitcoin mining have been outperforming significantly. One prime example is a crypto mining firm that just secured multi-year cloud service contracts worth $2.8 billion with top AI developers. It's a huge deal. But a quick word of caution, the underlying fundamentals of these dual-themed stocks are highly dependent on the macro environment, and they completely lack the protective moats of top-tier tech. So, the source document advises keeping allocations for these specific assets strictly below 3%. So how should we approach memory stocks? They offer some of the highest certainty in the AI hardware chain right now. Looking at the big three, Micron is currently seen as stable, basically the safest U.S. domestic play. Then you have SK Hynix, which is marked by high volatility, making it much better suited for short-term trading. And finally, Western Digital. Their core driver right now is actually a historic NAND supercycle, not HBM. So while they offer strong cash flows, they slightly trail the others when it comes to medium to long-term certainty. Take a look at Marvell Technology's current setup. The stock just went through a brutal 40% washout, but because of that, its downside valuation risk has narrowed substantially. Their technical fundamentals are still incredibly solid, so the 6 to 12-month recovery target is projected at $250 to $350 per share. That implies a target market capitalization somewhere between $220 billion and $300 billion. Moving right along to Section 4. Broad market technical thresholds, looking at how CTA quant models are triggering sell-offs. Algorithmic trend-following models, often called CTA quant funds, are hitting critical reversal thresholds, and the triggers have already been tripped. The Nasdaq 100 has broken right below its short-term threshold of 29,265 points, meaning those trend-following algorithms are already firing off sell orders. Similarly, the S&P 500 index just closed below its short-term trigger of 7,446 points.
The chart action we're seeing here is crucial. The S&P 500 fully filled the previous Friday's downside gap, but then it faced a really hard rejection, turning sharply downward right at the 5-day and 10-day moving averages. Because that resistance held so firm, we might see this shift from a simple consolidation phase into a much more accelerated decline, driven almost entirely by programmatic selling. Next up is Section 5, Tech Earnings and Market Share, exploring the Magnificent Seven rotation and AMD's data center growth. With over $3 trillion wiped from global chip stocks since June 22nd, a massive capital rotation is underway. A huge chunk of that capital sought safety in the Magnificent Seven, with Apple stepping up as a primary safe haven. But if we zoom in on the data center GPU market specifically, NVIDIA remains the undisputed king. They hold a staggering 95% of the market right now, leaving AMD with roughly 4.5% and others making up the last 0.5%.
But that landscape could be shifting. As major clients aggressively expand their AI partnerships with AMD, institutional analysts are now projecting that AMD could capture between 20 to 25% of that market share moving forward. It's definitely not all growth stories out there. IBM has been stuck in a prolonged slump following an earnings warning. Wall Street has heavily downgraded the stock, and the explicit warning for retail investors is to avoid bottom fishing purely because the valuation looks cheap. The underlying fundamentals just aren't there to support it right now. Finally, let's wrap up with Section 6, Speculative Assets and Downgrades, covering quantum computing, the space sector, and Oracle. We are actively witnessing the collapse of high-risk speculative assets that were previously inflated by geopolitical narratives and government subsidies. Quantum computing stocks are taking an absolute beating. QBTS crashed from $31 down to $16.70. IonQ tumbled 58%, hitting a 52-week low of $8.52. The catalyst? An SEC filing revealed a massive insider distribution of 23.25 million shares. Plus, they registered another 121 million shares for potential resale. That kind of volume completely floods the market. While they do have $30 to $40 million in annual revenue, their R&D cash burn far exceeds that, meaning there's pretty much zero financial floor for their valuation today. It's a very similar story over in the space sector. SpaceX hitting new valuation lows is creating a cascading effect, dragging down smaller, highly speculative stocks like WKLab and Lunar. Because this entire sector lacks deep historical data, jumping into bottom fish right now without waiting for broader narrative momentum to return is just incredibly risky. And to wrap things up, let's talk about Oracle, which is facing what looks like a death spiral. Blocked capital projects, delayed data center construction, and billions in potential sunk costs have led to Oracle's credit rating being downgraded to BB, junk status. A downgrade like that automatically triggers mandatory sell-offs from investment-grade bond funds, which causes their credit default swaps, the cost to insure against them defaulting, to spike to historical peaks. Looking at Oracle's technical defense levels on the chart, $120 is their absolute limit defense. If that fails, $110 is the next target, followed by the major psychological anchor at $100. If the price breaks below that $100 mark, Oracle's entire AI narrative is considered completely broken. So, with leverage wiping out in Asia and tech fundamentals being severely tested globally, the real question is, are we just seeing a healthy market correction, or is this the beginning of a much deeper algorithmic unraveling? It is definitely something to keep an eye on moving forward.